Eric, how's it going?
Good.
Yeah. Um, can you see my screen?
I can.
Okay, cool. I know this is recording. Got a handful of people on. Thought we'd go through it and then we can post the recording. It's the middle of the day, so not everybody's going to be on uh, right now. So I guess kind of like we talked about, and this will be fun because it's on the fly. We'll see what comes out of our respective brains on this. But for the people that are listening, there's the raise your hand button. If you have some questions that come up along the way, trying to keep this 20, 30 minutes, just kind of some high level overviews, ideas that especially Eric's been working on as CIO of Well Plan, and like he likes to call it, the drivers and the setups of what's going on in our economy. So I guess to kick it off, looking at the last year, I mean, it's been almost really hard to lose money, right? So we've seen NASDAQ, S&P, up, let's call it 15 to 20% since the beginning of the year, which makes it easy to build portfolios for the most part. Something that I haven't really looked at the numbers recently, but emerging markets are barely positive year to date. There's probably some currency issues there as well. And based on some of the things going on in China, the MSCI China index is down year to date over 30% at one point. So as pulling these charts today, it's down 25%, and emerging markets are still off 10%. And we haven't really seen any major drawdowns. Like we've, saw a pretty significant one last year when COVID first hit. We've had a couple of little blips here in the market, 10% corrections year to date. And so what's that look like? This Eric, feel free to chime in on this. When we're looking at portfolios, and especially from a quantitative optimization standpoint, I'll throw that out there. NASDAQ has been the dominant index or the dominant exposure. S&P 500, has had a great 10-year run like this chart, but NASDAQ really dominates anything. I think, a note that I was thinking of, or a note to this chart, is when you're looking at any of the quant-based softwares, that the NASDAQ risk return profile, the return really dwarfs, especially S&P 500. Wonder what that risk looks like, and does that have an effect on an optimization? So still going back, 10 years, I left the same indices on here, but looking at, let's call it the downside risk from a drawdown perspective, NASDAQ and S&P 500, really high downside correlation, and the drawdowns are, for all intents and purposes, over a long time frame, nearly the same. So I don't know, Eric, if you have any thoughts on the tech exposure or growth exposure of NASDAQ, does that have a bearing? Should we get out of the S&P 500 and just throw everything in triple Qs?
Yeah, there's a tendency for investors to want to chase the hot dot, and we see it in the data across many different kinds of markets. Probably the most pronounced thing that I've seen data-wise is if you look at the returns that investors in the average mutual fund experience versus what the reported return is, it's about half, roughly. So we know investors pile into assets after they've had a great run. So I imagine, especially on the retail side, we probably do see a lot of that behavior where people are capitulating and piling in. I take a view that this market resembles, to a degree, the markets we saw in the late 1990s, leading up to the tech bubble and then the tech crash. And the reverberations from that, obviously, we lived with for a number of years. There's a real tendency to want to pile in, and I'd say resist the temptation. The thing that stands out to me is the triple Qs. Those securities are inside the S&P 500 index. So any investment program that has an S&P 500 allocation and then also has a triple Q allocation, you're kind of doubling up to a degree on the tech that's been very, very good. And so I would say definitely resist the temptation to only be in the triple Qs for your equity exposure because it's dangerous and it's risky. People tend not to perceive that risk, or they tend to not be afraid of the risk in periods like this when they probably should be most circumspect about allocating to such a group of stocks.
Interesting perspective. So I'm going to go back to this mountain chart, looking at 10-year growth. And since we last spoke this morning, I found something, gonna call it a little gift to you, but from the aspect of, all right, the last 10 years it's been easy to, not easy, right? But it's been easy to accumulate. We've seen great return on investment from the perspective of portfolios. And so, do you have any thoughts on where we're at? Is the market overheated? This I guess includes the NASDAQ stocks because we're looking at the S&P 500. But what do you think? And this will lead into some of our other concepts. But what do you think about valuations right now?
So this is the Schiller. It's called the CAPE, which is the cyclically adjusted price earnings ratio, and that just means going back over time, they try to adjust for cyclical factors in the economy so that you're just left with a pure valuation measure. I wrote about this Schiller CAPE back in August of 2020, just really out of my own curiosity. And at the time, you can see where we were on this chart, not as high on a valuation level as we are now. So we move forward 1 year. I was concerned about valuations then. I'm concerned about valuations now. But the thing is, stocks can be expensive and stay expensive and get more expensive for a very long period of time. So just trying to use valuation on its own as an indicator for market exposure or risk exposure or timing can be pretty dangerous. And so when I look at valuation levels like this, and by the way, when you go back and you look at spikes in valuation, so this is going all the way back to the 1880s, and you can see the Black Tuesday, 1929. Sorry about the dog, you guys. The 1929 market crash. Those were highest valuations and never eclipsed until the tech bubble of 2000. And now we've got the tech bubble. We're eclipsing that and coming close to the 2000 tech bubble. At the time I looked at this a year ago, if you look at the 10-year forward return to stocks after a valuation spike like this, the returns tend to be flat or slightly negative, or at least if they're positive, well below the long-term average return to equities. And so I see this as a bad setup and not a great indicator for what things may be like an indicator that things may not be great over the next, say, 10 to 15 years from an equity return standpoint. But we can stay in the current trajectory with high valuations for a very long period of time. So I kind of think, it's worrisome that stocks are this expensive, but we might stay expensive for a while and returns might still be good until something breaks in terms of what's driving this.
Really interesting. I think we could dig a little deeper into some of the after effects of those spikes and some time periods too. That's really
I think that might be a really interesting paper to issue to you guys. Like, what are the forward 5, 10, 15-year returns on equities after valuation peaks? Could be quite interesting.
So what I heard from your perspective is it's not a panic button, right? Valuations can go higher, can persist. Yep. It's not a reason to sit completely in cash. Right?
Correct. Yeah. It can go on a long time and nice returns can be made in the meantime. And so I think you want to be vigilant. You want to watch this stuff. You want to be ever present with the data and the information, but not overly reactive to price alone.
Makes sense. We can switch gears a little bit. Let's go to, take a look at, let's call it the consumer, right? Kind of lower end of the food chain of a lot of things going on economically. This headline is, a lot of people have been basing a lot of, well, whether it's just for entertainment or actually, using the data for something, but the unemployment rate and job openings have been in the news quite a bit, and a lot of focus on that. So I guess, is that deserving, and do you have any interpretations on the data?
Yeah, so if you just look at the data here and we review what it means, we got the US unemployment rate in purple, the jobless claims in blue, and then the job openings in orange. And, if you look at the data, say during normal periods, which would be pre-COVID, you can see that we're not quite down to the levels we were prior to the economic shutdown related to COVID in terms of the unemployment rates, but we're getting there. The stark thing is the reopening of the economy has created a lot of non-farm job openings. And like when I say a lot, it's kind of unprecedented. We have this huge demand. Now, on the one hand, you could view this as inflationary because people are going to have to pay more to fill jobs. And so we could get wage-based pressure. But it's also really bullish for the economy because it says growth is back.
Interesting take. So do you think there's an effect of, we've heard for years people coming out of the labor market. Are there any data points that we should look at to take that into consideration? I mean, the job openings, I think I saw this morning, a lot of it's focused on industrials, right? And that ties into, if you're looking at REITs and price per square foot, especially storage space, and data farms in particular is what I was looking at. So I guess roundabout in my question, do these numbers match, or are we in some sort of a short-term weird little bubble?
Well, we may be at a societal crossroads because we've seen a digitization of many components of, say, economic deliverable, and economic consumption tends to be data enabled, which means people don't have to be physically present in a place in digitally enabled businesses. Like if you just look at what we're doing here, I'm in Gig Harbor, Washington, you're in Omaha. We've got people calling in from all over the place. This meeting is digitally enabled. And the job openings are not, it sounds like they're not digitally enabled, and people may be becoming more prone to want work that provides them the flexibility afforded by digitally enabled things, and not so excited about sticking their nose in a grinding tool for a 9-hour shift. And so we might be seeing aggregated preferences in workforce behavior.
Really interesting investment theme to look at as well. I think some of the obviously the SaaS businesses, valuations are up, and that's we just saw that, to tie that back to the NASDAQ chart.
Yep.
That we looked at as well. This is a really interesting kind of a mess, right? When we're looking at personal income and expenditures and prices, right? The price index, everybody was scared of inflation earlier this year. The numbers still support inflation. Do you think there's a mismatch here, or even a potential investment opportunity or an investment risk?
Yeah, so let's just kind of try to peel back the layers here and see what's going on. So we've got income and consumption in purple and orange, and then we've got price index in blue, and a month over month change. Well, so we got food and energy in blue, and then we've got the broader price index in green. And you could see, we're getting kind of spiky with the reopening of the economy and some of the things that I point to, like money supply and very low interest rates in my economic view of things. Um, Obviously, this is a little higher level inflation than we've had uh, in the recent, say, decade or 15 years. We still haven't run into what I'd call 70 style inflation yet. And there's a big debate about whether the current policies are going to lead to 70 style inflation. We saw massive lumber price pressure earlier in the year. That's cooled off a bit. But, there's still hot spots in the economy, whether it's fuel, what we're paying for gasoline, or whether it's certain food. I don't know if you guys have ever gone to a fast food restaurant. We did it in a pinch as a family about 3 weeks ago. For four of us at McDonald's, it was $50. Like, I was blown away by how expensive that was. Started to sound like my dad back in the 70s. But I'm like, you're kidding me. We just ate really bad food and it cost us $50. So I see signs of, let's call it percolating inflationary pressures. We see it in producer prices, and we see it to a degree in consumer prices. Whether it's transient or of a more lasting and a longer duration, we'll have to see.
Interesting. The lumber prices chart, I had pulled that a while ago, and it'd actually be something interesting to explain away as well. There's a number of factors that led to really the lumber spike, not just those on the surface. I guess there was some disease and infestations in Canada as well. So that was something we were going to write as a blog at some point. So I know, let's, since we call this the bull and bear case, this is something, again, a lot of squiggly lines, but to try and take a look at what the thesis is, right? Since home prices are up, obviously the real estate market has just been crazy. I guess once you talk about or explain what you're thinking here and what the path we were trying to go down, because I think it points to another leverage risk, right?
Yeah, so back in the early 2000s, I followed this economist named Ed Hyman, who was really good at what he did. And he was tracking something called mortgage equity withdrawal, or basically turning the home and the equity value in the home into America's ATM. And the cash being pulled out of homes was being used for everything back in that post-tech bubble bursting in the early 2000s. And so you would see people buying a second home. You would see people loading up on appliances, furniture, taking vacations, like well beyond income supported levels of spending in the broader economy. And, my thought behind some of the data in this chart is, can we see evidence of the home and the value of homes being used for broader economic expenditure, let's call it. And so you can certainly see that the home price index in purple making a high top and having a year over year rate of return of like 20%. That's a massive move, and that's US wide, right? So we've had a big uptick in the value of homes, and we've buried the crater created by the great financial crisis in home values. So we've recovered everything, and we're kind of even above trend line if you look back at what the trend may have been leading up to the prior bubble. At the same time, you can look at consumer bank loans and credit cards in orange to kind of say what's going on in the consumer borrowing and banking sector. And then you can take a look at the mortgage originations in blue. And so to me, it's quite interesting to see mortgage originations being kind of up and higher than U.S. existing home sales in green. So the blue right now is up above green. And to me, that's some indication of mortgage equity withdrawal behavior in the markets. Until we get better data on the so-called mu as a pure source, and maybe Steve and I'll go looking for that and see if we can't find it. I think there is at least a cautionary yellow here around what may be happening with home prices and second mortgages and that kind of thing.
Almost, you could make that some really scary data if you wanted.
Yeah, there's always stuff where you can scare the hell out of people and make a really compelling, scary case. And I don't think we have more of that stuff now, but we certainly have stuff we need to look at like this.
Yeah, I mean, what I had heard was cash out of my house and throw it in NASDAQ. Did I hear that from you correctly, Eric?
And buy the Nasdaq on margin.
Yeah, perfect. All right, couple more ideas here is all. Taking a look at what the yield curve looks like.
Yeah. So, the yield curve is not indicating anything right now that says we're looking at any recessionary forces in the economy. And if you go back and look at this chart and see when the yield curve had inverted, and this is 10 minus 2 year. And so if you were looking at like a super short term 10 minus 30, it got way more negative than this chart did. But I've said this before, I kind of think maybe we were heading into some kind of recessionary environment back at the end of 17 when you see us below the zero line. And then we had an overnight market problem where the Fed stopped its so-called tapering and started reinflating the balance sheet to fix overnight credit markets. That happened right at that first low. And then we were dipping down again even prior, we went back to negative prior to the COVID, and then we had this huge dislocation from COVID. But I have found the yield curve to be just a really good indicator of recession or something sort of not being right in the lending markets. And there's nothing in the yield curve right now to indicate that there's any economic dislocation risk.
Interesting. So just a couple more thoughts to go. This is kind of one of your go-to long-term bear concepts, right?
Yeah, well, I mean, we know this chart, the money stock in the overall US economy is way above trend line. And even if you control for, log factors and do a logarithmic scale, this is high and higher than it's been. And, we have unprecedented stimulus coming at the economy from both Fed policy with a balance sheet with low interest rates, and then add to that congressional spending, add to that mortgage withdrawal, and you get a lot of money sloshing around in the economy. When you get a lot of money sloshing around in the economy, it does things like bid up risky assets like the triple Qs, and it also leads to speculative pricing in things like cryptocurrency or Bitcoin, which we all know has done some amazing things. So this is a highly supportive money stock, but it's also worrisome because I don't think it's sustainable. Then this last chart is the Fed balance sheet. And, this goes all the way back to 2000, turn of the millennium. And you can see we had a very steady Fed balance sheet policy until the great financial crisis. And then we had a pop in the balance sheet. This is the so-called quantitative, some of it's just pure rescue finance, and then some of it's quantitative easing. And if you look back at that little blip from 2011 to 12, that was so-called QE2. So we had QE1 from the Fed, then QE2. And then you sort of have this line running from 13 all the way up to 14 where the Fed was just liquefying the economy by buying, assets onto its balance sheet. We went sideways for a long time, and then the Fed did the so-called taper on the right-hand side, that gradual decline in the balance sheet. The little uptick before the massive uptick on the right-hand side, the little uptick related to the Fed trying to improve the functioning of the overnight credit markets. That's when we got the the 11.5% overnight print in, commercial paper, like just a huge spike, and that looked like it was a liquidity problem related to them pulling money out of the economy via tapering of the balance sheet. Then we get the COVID shutdown and the massive balance sheet increase, and now we just have this steady state. They tried to pull it back there just about after the election, and I think they saw that it wasn't going to work and continued just to ratchet this thing higher. There are two schools of thought on the balance sheet. One school of thought is as long as the level of assets is high, no problem. The other school of thought is, well, it's really about the flow, not the level. I tend to be in the flow camp, and I think like if you thought of a garden hose that had air pockets in it, or if it was flowing purely with water and it was nice and systematic, this to me is garden hose water. And whenever you reduce the amount of flow, so when this chart starts heading down and not up, I think that's a potential shock to the economy. So I'm watching, because we've been hearing language about taper later in the year. I'm really fascinated to know what's going to happen when we start drawing money out of the economy because we're reducing Fed balance sheet levels.
Interesting. So yeah, those are some ideas. I guess, Eric, your takeaways on what we're doing, and then I'll point out a couple of things from our last investment committee and some of the portfolio positioning changes that we're doing, just a high level. But I guess what are your thoughts? And if I'm an advisor talking to my client, right, we've got some pretty scary stuff.
Yep.
How do you answer concerns, I guess?
Well, usually the kinds of concerns we're raising can lead to a feeling that somebody wants to get out, and that's almost never the right call. Like you market timing is so hard; it's just absolutely brutal. And I wrote the piece last month about, or maybe it was just early this month, about the 10 biggest investor mistakes, and market timing is one of them. So you don't want to get people in the habit of thinking, well, I want to get all out, or I want to be all in, or those are really treacherous things to do. But I think you want to be vigilant, and you want to tell people everything feels really good right now. Returns are up, and everybody's making money and high-fiving. And usually when that's happening, there's the risk is greater than most people perceive. So I think what we want to be is really vigilant here and tell people that we're watching it, and we may move toward more defensive posture. That may be appropriate. What that ultimately looks like is up to, I think, the advisor and the individual client. But for people that are really interested in preserving wealth and not taking a trip down the elevator shaft, some more aggressive defensive measures may be comfortable, maybe the thing to do. But I think you want to tell people it's never an all or none. We might want to do this around the margins and take some precautionary measures. And then we certainly have to be having a roadmap for, how to become more aggressive when the time is right. My mom's 89 years old. She's got 100% stock, which almost nobody would advise, but that's been a family mantra since the 1960s. Assets are 100% equity. So I think about her, and I think, might be time. My brother's the guy actually pulling the trigger on her portfolio. So my comment is it might be time to take more defensive measures for mom. And, at some stage, being more defensively postured is going to be right, given the backdrop of high valuations and all the supportive policy.
That's great input, Eric. And I guess just to kind of back that up, some of the changes that we made, focusing on our risk-based portfolios right now, matching them to a risk-aligned score, have had nice market participation for our level of risk, particularly in our defensive equity sleeve, which makes up the majority of most portfolios. We've got some things in there that we're trying to participate, but also have some mechanisms, that inside of these holdings can get out of. And this is, everybody should get this. If you don't, let us know, because this is a weekly dashboard that goes into each of the holdings to kind of show what's performed and what hasn't. But instead of the all-weather portfolio itself, we're not ever going to try and take that to cash, but we've got some inflation exposure via pure inflation ETF. We've got a couple of underlying tactical managers that are inside of funds inside the portfolio. So I think what we'll do is maybe we'll get some feedback, and maybe on the next session we'll dig deeper into that. I know that a lot of folks want to dig deeper into our individual stock strategies. The DAP strategy has performed really well. Select equity, it's been nice upside, and we've got Dustin and Nick that have been working on some write-ups on that. So we're trying to make this a monthly call. If there's some ideas, you can send it to research@wealthplan.group, and that goes to the whole investment team, so that we can incorporate that. If you haven't been receiving them or keeping up on it, we've been trying to put out more blog posts and market commentaries. Like I just mentioned, we've got a stack of some thesis adjustment and updates on individual names within the select equity and DAP portfolios. I know as our biggest strategies, a lot of folks will find that pretty useful. And hopefully everybody's got plans to attend the Wealth Plan Reconnect later this month around the Riskalyze conference. Erik's going to be out there, so you can pick his brain with that. And then we're almost at the end of the quarter again, so we'll have the investment committee meeting coming up, and just trying to get some ideas and content on everybody's screen or in their hands. And not sure where this will lead, but trying to make an effort to extract some of Erik's ideas and turn that into sound bites to use with clients. So just about on time. I think we can wrap it up with that. Erik, really appreciate you dialing in our virtual office setup, and maybe next month you come visit. I think we're moving into the new space upstairs, so we'll have a little better backdrop.
Look forward to seeing you guys at the next quarterly for sure, and down in Palm Springs or Palm Desert, whatever the case is.
Okay, we'll wrap it up for right now. Thanks, Erik.
Great. Thank you. Take care, everybody.